Global financial markets are navigating a period of significant uncertainty as an escalating military conflict in the Middle East continues to send ripple effects across oil, precious metals, and currency markets. Against a backdrop of verified military engagement, disputed headlines, and sharp price swings in commodities, traders and long-term investors alike are facing one of the more complex market environments in recent memory. In the past 24 hours, Iranian drones struck the United States consulate in Dubai and a central intelligence agency station in Saudi Arabia. In response, the United States military has deployed 50,000 troops, 200 fighter jets, 2 aircraft carriers, and strategic bombers in active operations against Iran. The escalation has pushed crude oil prices to $78 per barrel, representing a 40% increase since December. President Trump ordered naval escorts through the Strait of Hormuz and directed the United States Development Finance Corporation to provide financial backstop coverage for all maritime trade operating within the Persian Gulf. Oil markets initially responded to that announcement with a 4.5% decline, only to fully recover every dollar of those losses within hours. A rumor of ongoing negotiations briefly pushed oil prices lower again. Iranian officials publicly denied any negotiations within 30 minutes, and oil recovered once more. Secretary of State Rubio subsequently went on record stating that military attacks would increase in scope and intensity in the hours and days ahead. It is within that geopolitical framework that silver and gold are currently trading. Silver dropped to $77, recovered to $86.80, and was sitting at $84 just ahead of the 9:30 New York market open. Gold touched $5,000 even at its session low before recovering sharply, and is now trading above $5,186. The dollar index, known as the DXY, moved above the January 15th high before closing back below it, a formation traders refer to as a swing failure pattern. Turning now to the physical silver market, the data emerging from COMEX presents a picture of considerable stress at the structural level. Open interest in the March silver contract has collapsed to approximately 1,500 to 1,800 contracts, representing roughly 7 to 9 million ounces. The CME has effectively cleared out nearly all participants from that contract. The April contract, by comparison, has added approximately 100 to 150 contracts, with open interest rising to around 1,000 to 1,200 contracts, equivalent to 5 to 6 million ounces. The paper rollout is occurring under visible strain, with those standing for March delivery neither rolling quietly nor exiting without resistance. Total COMEX silver inventory has now fallen to 355,173,000 ounces, marking a new one-year low. Registered silver, which represents the metal actually available for delivery against open contracts, stands at 87,985,000 ounces. On Monday alone, 2,391,000 ounces were withdrawn across 3 separate vault custodians simultaneously. Brinks, CNT, and Loomis all reported outflows on the same day. Over the past 30 days, total drain from COMEX silver inventory exceeds 50 million ounces, a reduction of 12% in a single month. The leverage ratios attached to those inventory numbers provide important context. The total inventory leverage ratio currently sits at 1.62. The registered leverage ratio, measuring contractual claims against the silver actually available for delivery, stands at 6.55 to 1. That figure means that for every single ounce of registered silver held on the exchange, there are 6.5 ounces of contractual claims resting on top of it. That registered figure continues to decline. Delivery activity reinforces the same picture. 241 delivery notices were issued on Monday alone. Total March deliveries have climbed to 5,870 contracts, representing 25,435,000 ounces of physical silver being demanded through the formal delivery process. Among the institutions stopping those contracts, JP Morgan stopped 71, Wells Fargo stopped 38, and Bank of America stopped 37. These are large financial institutions going through the formal COMEX delivery mechanism to take physical metal directly off the exchange. Lease rate signals are also sending an atypical reading. The 1-month silver lease rate, which should approximate 0 under normal market conditions, is not doing so. The 1-year swap rate is showing distortion in a direction that prices in backwardation risk, meaning physical silver is more expensive to borrow because accessible supply has contracted. Notably, approximately 15 million ounces of physical silver were sold by retail investors since February 9th. That level of selling would ordinarily be expected to ease supply pressure. According to the data, it did not move the stress indicators in any meaningful direction. Shifting to Shanghai, the SGE updated its silver inventory numbers following a period during which those data lines were completely absent from reporting. When the figures returned, they showed 13.2 tons drained from SGE vaults. The Shanghai Futures Exchange separately reported 47,000 ounces withdrawn on Wednesday alone. Total SHFE silver now stands at 9,478,000 ounces. Total SGE silver sits at 14,380,000 ounces. Combined, that represents 26 metric tons removed from Shanghai vaults within a single reporting window. The Shanghai Premium provides additional context for how Eastern and Western markets are currently diverging on silver pricing. Western spot silver is trading at $84. Shanghai spot silver is trading at $97, a $13 premium. That gap remained intact even following the 11% decline in Western paper silver prices. When the paper price fell sharply in the West, the premium in Shanghai did not narrow to reflect it, indicating that physical buyers in China were not transacting at Western paper prices. Returning to the Gulf, the market reaction to the Trump administration's naval escort announcement and DFC insurance backstop for maritime trade carries historical context worth noting. Oil dropped 4.5% on that announcement and fully recovered within hours. The DFC insurance mechanism backstops trade finance. It does not physically move tankers through a contested strait, nor does it protect upstream energy infrastructure. A prior sustained United States-led coalition campaign against Houthi forces in the Red Sea resulted in Red Sea throughput that never recovered above half of pre-conflict levels, with U.S. assets lost and the campaign ultimately assessed as a failure by U.S. military leadership. Iran maintains indigenous drone production, estimated at 500 units per day, at a cost of $35,000 to $50,000 each. United States intercept costs run from $1 million to $3 million per missile, often requiring 2 or 3 missiles per target. The confirmed facts of the current engagement include the United States military sinking 17 Iranian naval vessels, including a submarine. The Strait of Hormuz is under declared Iranian naval supervision. Iranian officials have publicly stated they are not engaged in negotiations and are committed to a prolonged conflict. Secretary of State Rubio has stated that attacks will increase in scope and intensity. A negotiation rumor circulated during the session that caused oil prices to drop, followed by an immediate public denial from Iranian officials within 30 minutes, after which prices recovered in full. On currency markets, the DXY tested the January 15th high, surged above it, and then closed back below it. That constitutes a failed daily breakout. European equities, bonds, and the euro were observed falling together in the same session, a configuration that reflects capital exiting a region. That capital flow is currently moving into the dollar. If the DXY were to achieve a confirmed daily close back above the January 15th level, that development would represent additional near-term pressure on metals prices. The Shanghai Premium, oil prices relative to the $78 level, and DXY price action are the 3 data points identified as the key variables to monitor going forward. To bring together everything covered in this report, global commodity and currency markets are operating under conditions defined by active military escalation in the Middle East, atypical stress readings in the physical silver market, and sharp, rapid price movements driven in part by disputed or quickly reversed information. Each of those elements is interacting with the others in real time. On the geopolitical side, Iranian drones have struck the United States consulate in Dubai and a CIA station in Saudi Arabia. The United States military has 50,000 active troops, 200 fighter jets, 2 aircraft carriers, and strategic bombers engaged in operations against Iran. Oil has risen 40% since December to reach $78 per barrel. A naval escort order and DFC trade insurance backstop announced by the Trump administration were rejected by the oil market, which fully recovered its losses within hours of the announcement. Iranian officials publicly denied any negotiations within 30 minutes of a rumor to the contrary, and Secretary of State Rubio confirmed that military operations will increase in scope and intensity. On the metal side, gold touched $5,000 before recovering to trade above $5,186. Silver reached a low of $77, bounced to $86.80, and was trading at $84 ahead of the New York Open. The DXY tested and failed the January 15th breakout level, forming a swing failure pattern on the daily chart. Within the physical silver market, COMEX registered silver stands at 87,985,000 ounces, against a registered leverage ratio of 6.55 to 1. Total inventory has fallen to a one-year low of 355,173,000 ounces, following a 12% drain over 30 days. 3 vault custodians reported simultaneous outflows on Monday. Large institutions including JP Morgan, Wells Fargo, and Bank of America are taking physical delivery through the formal COMEX process. Silver lease rates remain distorted. Retail selling of 15 million ounces since February 9th produced no measurable easing in supply stress indicators. From Shanghai, 13.2 tons were drained from SGE vaults, and 47,000 ounces were withdrawn from the SHFE in a single reporting window. The Shanghai silver premium over Western spot pricing stands at $13 and held firm through an 11% decline in Western paper prices. The three indicators identified for ongoing monitoring are the DXY relative to the January 15th daily close level, the Shanghai premium for signs of shifting physical demand in China, and crude oil relative to the $78 threshold as a leading indicator of the conflict escalation framework. That is a complete summary of the data and developments covered in this report.